All right, so working towards one chart. Again, looking at our small triggers, just want to have you guys have a visual focus on an indicator. Okay, so small triggers relative to everything is what we're going to be doing today. And again, if they tell us an area is going to hold or break, and it's a very simple concept. If the small triggers break through an area, whether that's Fibonacci areas, support or resistance, or a mid-band, that area has a tendency to break. If the small triggers roll at or below an area, the market has a tendency to reverse at that area. So that's one of the key concepts we're going to look at. We're also going to look at the small triggers relative to that area. So if we're at a mid-band and we're thinking about going short, but the small triggers break through it, we're not going to do that. If the small triggers break through Fibonacci areas, we're not going to use them. And then we also, obviously, for those of you guys that have been around, for those of you that are new, the small triggers will alert us to a trend change by simply crossing above or below the other synthetic triggers. So if the small triggers are above the other synthetic triggers, trend is normally up. If the small triggers are below, so what we're talking about is location of the triggers, small triggers relative to our synthetic triggers. So we're going to do our normal trend trades, right? And in a trending market, as long as our small triggers don't get beyond the 8.2 or 12.3 synthetic triggers, we'll keep taking trend trades. For our counter trend trades or trading off of Fibonacci support or resistance areas, we have to have the small triggers break out of the area and then retest the fib area. And we're going to go through and look at a lot of examples of this on the chart. Trade management, very simple. Stops are behind the pivots and tails. If a small trigger is on the wrong side of our 8.2 synthetic triggers, we're going to manage out of that trade, right? We're going to manage that trade a little tighter. So again, I'm going to post a document into the room so you guys can have that. All right, so here's what we're going to be looking at. We'll start off with the NASDAQ. Okay, and we'll go back to earlier today. All right, so here's midnight. All right, and here is a breakout to the upside. Right, and what you're going to see is that, while the market obviously, had fib to fib oscillators at the 25 buy line, our small triggers were on the wrong side of all of our synthetic triggers, which, some traders would take this as a trend trade. Again, the thought process behind this is to have the small triggers on the correct side, meaning above for long trades, are synthetic triggers. Okay, and the more our small triggers break below the synthetic triggers, we're going to have more of a tendency for the market to go down. Now, not necessarily a short trade there, but just kind of reading small triggers relative to the synthetic triggers. All right, so as we kind of work our way forward, you can see that the small triggers got above all of our synthetic triggers. And this is what we're talking about when we talk about a trend change. With the small triggers breaking above our synthetic triggers, that means that the market has a tendency to go up. All right, now for us to do trend trades, remember, we have to have our either Fibonacci support or our midband, and we also have to have our fib to fib oscillator get to the 25 buy line, at least for a long trade. Okay, so this would have been your first long trade. And this happened a little towards 6:30 this morning. All right, and you can see that our small triggers are above our synthetic triggers, so we're just going to trail up behind stops and or behind pivots and tails, right? And that market essentially went all the way to Fibonacci resistance, right, without getting stopped out. Obviously, Fibonacci target area for us, right? So your first trade from, 45, 69 area up to 85. Hopefully some of you guys got that trade. We'll take a look at some of your charts. All right, so now you see resistance. Now here's where, obviously we didn't break below all of our synthetic triggers, right? This is what we're going to be looking for in the case of a counter trend trade. Okay, we're going to look for the market to hit resistance, and then we're going to be looking for our small triggers to break down below. Now, in the middle of wide, very large synthetic triggers, very dangerous to go short. And you can see the market does continue up here. Right now, the exception to this one will be if we have a large gap back to our areas, right? If we're in the middle of wide triggers going up, you're not going to do counter trend trades here. All right, so obviously the market goes up. And here's where the market changes the trend to the downside. Remember what we said about trends. Small triggers getting below all of our synthetic triggers. Right? And this would have been your first short trade. Right? Now, remember we talked about the management side of this, right? Which is what? If the small triggers are on the wrong side of the 8-2 synthetic triggers, we're going to manage out of that trade a little tighter. All right, so look at the point of entry for the short trade. Notice that your small triggers right here so this is what we're talking about. I may have to. If the small triggers are on the wrong side of the 8-2 synthetic triggers, you're going to manage that trade a little tighter. All right, so that would have been your short. This would have been your exit. Everybody understand that? Pretty straightforward, hopefully. So what we're going to do is we're just going to watch, here's when newer traders look at our software. Right? This is 99% of what we do during the day. Right? Reading the smaller chart and deciding, because I want you to keep in mind when we have all of the information on the larger chart superimposed on the smaller chart. The trigger lines that you see on the smaller chart are the exact same trigger lines that we have on the larger chart. Right? There's no difference between these trigger lines. Now, the only thing that we don't have on our smaller chart that we have on our larger chart is Fibonacci support and resistance areas. Did everybody hear what I just said? So I want you to really think about what I said. We don't have our support and resistance areas from our larger chart. Now, I'm in development right now to be able to superimpose just the current support and resistance onto our smaller chart. So my intention is to have all the information from the larger chart on the smaller chart so we can make easy decisions. Then you don't have to look at your large chart and say, what's it doing, and your small chart and what's it doing. You'll be able to already do that. Now, we already have this, to some degree. Obviously, if I turn on the strategy, just to give you an example. Right, I'm going to expect that it did a trend trade short. I'll put it on back test version so you can see. Oops, got to turn it on. Happens to me too. I'm going to go on the assumption that it pretty much did everything that we just talked about. Trend trade short and trailed out after the reversal bar to the downside. So it did everything that we talked about. Now let me see what it did over here. Unfortunately, it got a little bumped out right there at the bottom, but it had the same trade that we were talking about. The one thing that I want you to notice is that with this trade over here, and this stop being so tight, notice that your small triggers were still inside and going up inside of your 8-2 triggers. So a little management issue with the system right there, which we'll be working on. All right, so only looking at one chart, what do we have? I mean, obviously we had a trend trade short there, right? And we got to the outer band, but more importantly, we were on the wrong side of our 8-2 triggers, and that's why the management happened. So very simply, what are we looking for? Well, we're looking for another trend trade, right? So we have to get close to our mid band, and we also have to have our fib to fib oscillator get to the 75 sell line in order to generate another trend trade short. Right? If our small triggers break through the mid band, we will stop having short thoughts. Right? So we'll go look at it on crude oil as well. Okay, so this is, we can start from an earlier section. So here's midnight. All right, and the market trades up to resistance. Now this is what we're going to be looking for counter trend trades. And I want you guys to see it written in the rules, right? Let me get a little bigger text version so you guys can actually see here. All right, so for counter trend trades, the small triggers must have a breakout of the 8-2 white and cyan synthetic triggers. And then the market must retest Fibonacci area before trading. Okay, so notice your small triggers here. Everybody agree with this one? I want to make sure that you really see what I'm talking about here. The small triggers break below the synthetic triggers. Does everybody see that? Just give me a yes in the room if you see it. If you don't see it, tell me now, because we need to have this concept 100% before we really make this super simple. All right, so having the small triggers break below the synthetic triggers means what? we can sell Fibonacci resistance. This is going to be our counter trend trade. Right? What I'm trying to do is I'm trying to add just an ultimate level of simplicity to reading the Fibonacci areas, reading the mid bands, and being able to really feel comfortable with whether you should be going long or short. Right? So does everybody understand that potential for a short trade? Now that trade went from 46.24 down to 45.91. So there was almost what, $250, $340 from Fibonacci resistance to Fibonacci support. All right, as we progress through, you can see what happens. Our small triggers start to break above, right? And we end up with trend trade rules, right? But it's almost the same thing as over here, right? If I was, I'm gonna get rid of the bigger trigger since we're not using that really in the rules here at the moment. You can see the small triggers. I'm gonna cheat and just change that to above. Does everybody see that? Small triggers break above your synthetic triggers. We retest the Fibonacci support area, and it just so happens that we have a trend up and we have fib to fib oscillator, and we end up with basically, a trend trade look to the upside, which that trade runs up to resistance, right? Ultimately, resistance is our target area. All right, so just these two trades alone from, of course, this is way earlier at 3:30 in the morning, and then from 7:30 to 8 a.m., look at the price, 45.95, call it 46, up to 46.35. Simple rules, reading the areas, trading from Fibonacci resistance to support, waiting for the trigger lines to say it's okay, trading support up to resistance. Just those two setups alone on one chart should have netted you out 2 or 3 times your daily goals. So I just want to make sure that everybody understands the rules before we get into this simplicity. What was the large chart doing? Today I'm going to go out on a limb and I'm going to say, who cares? I want to try to make this as simple as possible for you. All right, so going forward, all right, let's use those same rules. Actually, I'm going to cheat and steal this. Can everybody agree that our small triggers have broken below all of the synthetic triggers here? Which means what? We're going to try to trade Fibonacci resistances if we have them. Do you see any Fibonacci resistances on your chart? Absolutely. It's the big red line. Right? And it just so happens that you have your fib to fib oscillator at the 75 cell line at the same time. Not 100% necessary when, trading that first counter trend trade going the other way, but an added bonus to what we do. So I want you to think about it. Counter trend trades, this is what we just talked about. Small triggers breaking the synthetic triggers, getting on the correct side, and then retesting the Fibonacci area before trying to put a trade on. It's as simple as it can possibly get for trading support and resistance areas. If the triggers don't break, the synthetic triggers, we don't look to trade the support or resistance. It's very simple. Right? And ultimately, this is your Fibonacci target. Right? So let's talk about the management side. Right? So what do we say on the management side? Well, we're going to trail our stops behind pivots and tails. And if our triggers are on the wrong side of the 8-2, which doesn't count in this scenario, we'll manage out a lot tighter. So where would your initial stop be? Let's go ahead and just mark that on the chart, make it really simple. The stop's going to be above the pivot. Now, as the market trades down and makes a retracement and then starts to go down again, we can trail our stop above the new pivot. Yeah, it does. And it's pretty easy to see that your small triggers are well below all of your synthetic triggers. Steve, that's the beautiful thing about what we do. Your question is entry at the reversal bar. Should you wait for the reversal bar for an entry? Let's go back and look at the 3 trade setups we talked about. Okay, and let's look at the cost analysis for the reversal bar. If you got in at the fib, let's just say for an example, you sold 46.24. Can we agree to that? That's where the Fibonacci line is. Okay, you probably would have had to risk, your 8 to 10 ticks to get above, right? So initial risk, just say 8 to 10 ticks. That would have put you well beyond all of your other lines. Okay, then once you had your first down bar, your stop would have gone in at 28 or 29. So you would have had a stop placed, right? Just like we talked about, stop above the pivot. You would have ended up with 4 ticks of risk, right? Then you had a new pivot and a new tail, and you would have had a new stop in place, which probably would have put you at 2 or 3 ticks risk. Then you would have had a stop here, just kind of taking that stop logic down, right? Behind the new big tail and then behind the new pivot, and then ultimately reach your target. Okay, now if you would have waited for the reversal bar, you would have been filled at 46.16, assuming no extra slippage. Everybody agree with that? So if you waited for the reversal bar, which is totally acceptable, right? Now, we talked about this some yesterday. Waiting for a reversal bar or not. What's the key determining factor on whether you should wait for a reversal bar or not? The look of the small triggers. If the small triggers are going down strong, typically you can sell the area and get away with it. If the small triggers are coming against you, let's just look over here at this next long trade. Right? If you bought the fib, you would have still been okay, right? You would have survived this one. If you waited for the reversal bar, right? If the small triggers are coming down strong, you wait for the reversal bar. If they're still coming down strong, then you wait for a little retracement after the reversal bar. So ultimately, somewhere right in here is probably where a really good fill is for this long trade. I would like to take full credit and say just get in at the fib, right? But realistically, when the small triggers are coming down, you need to wait for that reversal. If they're still coming down strong, typically you can get a deeper retracement to get a better entry. Right? But either way, whether you're filled here or here or here, if the market does what it's supposed to do, which is go to the next target, then, we don't want to trip over the pennies to get to the dollars. Right? So again, same thing here. If you would have waited for the reversal bar, you would have been filled right here. If you sold at the area or somewhere in here, obviously you ended up with less risk, more profit. All right, so turn that off here. And obviously it's slowed down a little bit, but you can see what we're talking about. If you only, I'm going to turn the strategy off for a minute because we're not needing it really for what we're doing lesson-wise. Right? If you would have said, hey, I'm going to remain in this trade and just trail down behind stops and pivots, you're still short. Right? With a stop right here. Typically, right, I would rather see you take your money and wait for the next setup when you trade from the wrong side of your synthetic triggers. That's why we put this rule in here. Trade management. Two choices. You trail it behind the stops and the pivots, or the pivots and the tails, excuse me. And if the small triggers are on the wrong side of the 8-2, take your money, take your money, take your money. So does everybody understand the rules? All right, so now look what happened. We have gotten to basically the target for a short trade, right, which is getting to Fibonacci support. Now we have to see what's going to happen, right? What do we need to see in order to start thinking about long trades, right? Which we can't think about yet, can we? Why can we not think about long trades? Because our small triggers haven't broken out above our synthetic triggers. We know we have support here. That's great. We love support. So support has to do one of two things: break, or small triggers have to break out to the upside. And then we can go the other way. Does that make reading it about as simple as it can be? Hopefully so. All right, so we'll watch them both together. All right, so if you're not in a crude oil trade, right, our trend is down. We're going to watch the small triggers in the area that we're contending with, right? The area that we have right now is our midband. Everybody agree that's your area of resistance? We have to try to determine if that resistance is going to hold or break based on the location of our small trigger lines. What do you guys think? Should the midband hold where our small triggers are right now, or should it break? Remember the key concept for an area holding or breaking, and it's every line, right? If the small triggers are getting through the area, we expect a breakout. If the small triggers don't break through the area, we expect a reversal. And we'll see. All right, so we have the potential for a short trade, assuming that they don't break. If they do break, that's okay. It just means that we're not going to do that last short trade. Well, if we get a reversal bar here, okay, I'm going to make this really simple for you guys. I want you to watch the slower of the two triggers. So this is the one you're watching. Okay, if this slower trigger gets beyond the midband, the party's over. All right, guys, so you can see what we ended up with, right, on the NASDAQ. Can we all agree that the small triggers have broken above? So we have now Fibonacci support with the small triggers breaking above our synthetic triggers. All right, so let's look at our crude oil. You can see what's happening, right? The small triggers are getting beyond the midband. So let's look at the rule for this, and you can see we got back to, right? If the small triggers get beyond the fib or the midband, you're going to have to wait until they get back on the correct side of that area. Okay, so you can see already we've got our long trade in the NASDAQ. Hopefully, you see that. Right now, we're not going to have a short trade in crude oil until what? Until we either hit a fib and then we assess that as our area, or we get back below our midband, one of the two. Hopefully everybody's got your long trade going in the NASDAQ here, right? MB. Yes, they broke the midband, but you also had a second support area, didn't you? Did they break the Fibonacci support? All right, so we're trading off of support after the small triggers change their trend. Right? Now, stops, let's talk about management again. Stop is what? Below the pivot. And the market traded way up. Probably people took their money up here, but if you're still in for the long run, then your stop is here, below this pivot. Right? Most people, once the small triggers start to get outside of the synthetic triggers, will be done with the trade. So let's see what, Howard, see what you did. So you went long off of the support with the simple rules, made some money. Good job, Howard. All right, so if you're still in this trailing behind stops, there's your new stop level, right? So stop below the pivot, stop below the pivot, stop below the pivot. MB, that has nothing to do with what we're talking about. We're not talking about the automated trading system. We're talking about trading a simple chart with one simple set of rules. Here's the rules again for everybody who's coming in late. And I'm also recording this so that way you guys can have a copy of it and review. So we had a short trade, right, where we managed out. We hit Fibonacci support. We waited for, well, there you got a new stop again. All right, we had a new Fibonacci support. Small triggers got above, pulled back to retest it. Long, still long, still long, still long. How far is it going to go? I don't know. So, Scott, you went long on natural gas here. Notice that that's not your support area, Scott. You went long out in the middle of nowhere and had to fade a lot of heat, right? Buy support lines, get out at resistance lines, right? And you can't sell resistance or you can't sell support. You got away with it, but you can't do that. All right. Scott, if you think you're missing some trigger lines, just right click on your chart and go to templates and then go to load. And then you can put on the 5-1 all inclusive is what I have running on my chart. So right click on your chart, load chart template. All right, so let's just look at crude oil for just a second here, guys. All right, so we had short trade over here, right? I think everybody agreed with that one. Right? We didn't make our Fibonacci target. It pulled back to the mid band, the small triggers broke through. It pulled back to Fibonacci resistance, the small triggers broke through. All right, so we should be looking for what? Long trades, right? Everybody agree with that? All right, so now let me ask you a question. Small triggers are where? Are they above or below, or would we not really know whether they're above or below? Right? We have an area to contend with here, which is what? Your mid band, right? Is this going to be a mid-band long trade for you if the small triggers remain above the 8.2s and the small triggers remain above the mid-band? Yeah, it's about the last spot. If it goes down much further, then the small triggers will get through and then that'll be it, right? Which is about what we're ending up with now, it looks like. I'm going to blow this up a little bit here. Keep in mind, guys, there's not a trade at every turn in the market. Right? We still have to have rules met for our trades. All right, so now, would you guys agree that relative to our 8-2-12-3 triggers, our trend is down? All right, so here's the question. Will you take a trend trade short if you get one? All right, so we have news coming out, is what you're saying. Now, today is Wednesday, so at 10:30, we're going to have crude oil news. So let's go back and review what we talked about. Okay, since we're kind of in the middle, probably going to be looking at trend trade shorts on the NASDAQ here, potential trend trade longs in crude oil if they don't die totally. All right, so let's look at the rules one more time. And we're going to go over the rules and over the rules and over the rules. All right, so the small triggers will tell us if an area is going to hold or break. Right, what that means is that if the small triggers are below the mid-band will usually hold. Okay, we're also going to be alerted to trend changes when all of our trigger lines, synthetic trigger lines, get violated by the small triggers. So we're only going to trade with the trend based on what these trigger lines say. Now, in a trending market, as long as we don't violate our 12-3 red and green synthetic triggers, we can take a short trade. So this is your break beyond point right here. If the small triggers violate these larger synthetic triggers, then we're not going to do a trade. All right, so what news do we have out today? Obviously, we better take a peek at that. All right, two things, guys, real quick before we get too far into this. Did the small triggers say that you can go short at your mid-band or not? Or did the small triggers say that you can still sell because of your synthetic triggers? I think the answer is no, right? Right, this is what we're talking about with a trend change to the upside. When the small triggers physically get above your area, you have a trend change to the upside. Sorry guys, sometimes it takes me a minute to write it on there and talk about it, but you can see it, right? So going with the simple logic, one simple chart, right? That was probably the last spot you could look for a short. Let me write it on the chart for you here real quick. So that was the last spot for a short that didn't happen. Then we had a trend change up. You know, if we had a fib here, that would be our conditions for going long at a fib, right? You know, not sure you can really do it from just a mid band. We like to kind of reserve that for Fibonacci areas, but same concept, right? You shouldn't have been looking for anything except for the market to go up from this point. It's not subtle. It's not iffy. The small triggers break above everything. Pretty good chance you keep going up. All right. Now, keep in mind today we're going to be looking at just one chart. Right, so I don't even know what the large chart's doing. I don't know where the fibs are. I don't know where anything's going on the large chart. So there may come a time where the smaller chart tells us to do something wrong into a larger chart. We're not going to concern ourselves with that today, are we? I want you to really get the idea of simplicity. Okay, once I finish my next round of programming, we're going to have the fibs from the big chart superimposed on the small chart. So we're going to have all the information from the big chart on the small chart. Now, where are we going? We had a trend change up. Our Fibonacci target area is where? 4612. All right, now we do have some non-manufacturing PMI news out at 10 o'clock. So we'll see if they can finish a run up to the Fibonacci target. Does everybody understand the concept to the trend change? Small triggers breaking through all the synthetic triggers, trend change up. Hopefully so. Steve, Ninja Trader's done something to it. I don't know what happened. So I've got a new version that I'm working on, which will be much cleaner and not have any technical issues. All right, so I think pretty easy. There's nothing going on in crude here at the moment. So pretty easy to see the trend change up. Pretty easy to see where our target area is. Right, so we're talking about the potential of selling this area. Right, and we're talking about a very important lesson, which is, can I just jump in at this area or not? If the small triggers were already crossed down at this area, then absolutely. But that wasn't the case, was it? So you had to wait for some reversal bar action. So you have something other than the thought of selling there that helps you. Right? Now I want you to recognize, right, that we did break out to the upside, which is fine. But very quickly, the small triggers are starting to break back down to the downside. What do the small triggers say about support and your midband? See how they're already below it? That's a good indication that this area is not going to hold yet. Right? And we're on our small triggers are on the wrong side of all of our synthetic triggers, which means we're not looking for a long trade anyway. Because I know it's tempting to buy support, but if your trigger lines are that far below, you don't have the high probability of it winning, and you have a higher probability of support breaking. We'll see what happens. All right, so go back and look at a couple of your trades that you guys posted in. Drew, you bought Brent crude and made some money on that, so good job. And Drew, let me see what you did. You also bought the NASDAQ, which is pretty much where we were talking about buying. and took it up close to resistance. So good job there. And Michael, let me see what you did. You went short on crude and took your money on that one. So nice job there. Again, same concept. Small triggers breaking below. Obviously, you got a really deep pullback, between the triggers and the fib. So nice job there. All right, guys. So this is a situation where what? Small triggers broke below. Trend is down. All right. Would you guys agree we're looking for sell signals? All right. So we do have news coming out in just a couple minutes. So that, may not want to trade in front of news, which if you don't, that's okay. Let's take a look at our crude for just a second. We have crude news at 10:30. All right, same concept here, guys. Small triggers, look what they've done on our chart, which means more potential sells in crude oil. We'll watch them both here at the same time. All right, guys. So you can see the NASDAQ has gotten, again, small triggers on the wrong side of our 8-2 triggers. So we're going to do the same thing. We're going to wait, and news will probably make it jump, I would imagine. Everybody agree that the only thing that you could really look for is the potential for short trades. Hopefully you see that. We'll just watch one market for now. Nice and one market, one chart. Nice and easy. All right, so now we've pulled back into resistance. We'll see if they stop or not. Right, and they can get as far as the other synthetic triggers, so we're not still totally against sells if it holds, but we'll have to see. Notice our small triggers almost broke out, but didn't quite yet. So they tried to change the trend to the upside, but they couldn't do it yet. What do you guys think? Shorts? If you're short right there, your risk is what? Above this pivot. Hopefully you guys saw shorts or see shorts. All right, and again, I'm not doing this with the benefit of any other charts. We're doing it with one chart. Very positive ISM news, okay? What's it going to take for us to do long trades? We're going to have to break out above these synthetic triggers. It's pretty much on this chart, short, short, and nothing but short thoughts until further notice. Right now that may change, but for now that's all we've got. Right now divergence is one of our exit criterias, or at least it makes it bounce up a little bit higher. Right? Sometimes it changes the trend, sometimes it doesn't. All right, we already know what's going to change the trend for us, and here it is. Small triggers starting to get through our synthetic triggers. So now we've changed the trend back to up. We have the potential for long trades from support, right? Would you guys agree with that? As we start looking forward, assuming that we go up, I don't even know where my next fib resistance is. It's up there. So we use outer bands and, trigger lines as first target areas anyway. Your stop is right below the pivot, right? If it gets back down below there, then that's the end of that trade, right? And we talked also about, can you buy that area aggressively? Well, if your small triggers are still up, you can get in at the fib and you've only got a few ticks worth of risk now, right? If it goes, great, you make a bunch of money. If not, you lose a few ticks here. Does everybody understand that thought process of small triggers are still up? You can get in a little more aggressively at the area, which, creates a small stop for you. If it gets there and doesn't keep going, right, then we can reevaluate. When you hear traders talk about, I take a very small stop or a very small, right, that's the first kind of aggressive scenario at that trade. Now we end up with potential trend trade long rules, right? Fib to fib oscillator coming down. Of course, our small triggers are coming down, so we'd have to have confirmation to the long side, which would be in the form of a reversal bar up. Right, so if you were getting in aggressively at the area, you might have lost a couple ticks. Then this is the last chance for a trend trade long. With confirmation. As long as our small triggers don't break the area or break our synthetic triggers, we get that long trade to happen. Now, what's it going to take to change the trend? Same thing it takes every time, right? Small triggers breaking below all of our supports and mid bands and Fibonacci areas and everything else. We've gotten a tad bit choppy here since the news, but trigger trend is up, right? Here's your new stop level. So if they keep going, great. If not, we've got a new stop area below a pivot. Kind of tight quarters since news time, but all right. So does everybody feel comfortable with what you're looking at as far as areas and direction? That we started out with potential short trades over here. I know this was in the news, but potential short trades. Then divergence changed the trend up and then pull back into support. And now it's just kind of meandering around, kind of struggling here. All right, Shirley. I know you're sitting there wondering, is it going to keep going up or not? The answer is, I don't know the answer, right? So if we get a new reversal bar to the upside with a big tail on it, we'll have a new stop in place. And we'll see how far it goes, right? There's a new stop. As long as we don't take out that stop and we keep making tails and pivots going up, it's going to keep going up. All right, and that would have been probably the end of that trade, obviously. So the question is, do we get another one? Or are the small triggers breaking through our synthetic triggers? Right? Our small triggers breaking through the synthetic triggers means no more long trades. Now we don't have an area for shorts, right? And it doesn't mean it can't go up, right? But for us, for our conservative rules on what we're doing with one chart, I want you to recognize that the small triggers have violated the synthetic triggers. That means no more long trades. Now, you can't do short trades because there's no resistance. Does everybody see what I'm talking about? Small triggers breaking below the synthetic triggers, no more long trades, even though it may go up, right? The area still says up, but we don't have the conservativeness of the triggers being on the correct side. So we skipped that last one. Yes, I understand. No, I don't understand. I have no clue. Help me, John. What do you guys think? We're keeping the small triggers on the correct side of everything in order to do the most conservative trade setups. All right, so let's look at your crude. Not much has happened, right? We anticipated the potential for more down, right? And we have yet to pull really back to a resistance area in order to get that short trade. Now, we do have big crude oil inventory news coming out in 15 minutes, so conceivably there might not be anything that happens before then. Okay, Carl, good. Right, so yeah, the market did bounce up, but look how limited that bounce up was. And we already knew that because our small triggers had violated the midband, violated the synthetic triggers, which is our first warning sign that the market may not go any higher. Right? In order for us to think about doing long trades again, we're going to have the small triggers break above our synthetic triggers. Would you like me to be honest, or would you like me to give you a politically correct answer, Scott? You've already given the key indication in what you said. How do I feel about adding on contracts to a bad trade? Number one, why would you take a bad trade? That's the first portion that gives me concern. Number two, if you did take a bad trade and you knew it was a bad trade, why would you put more risk into that bad trade? So I'm going to answer your question with a question. Yeah, I know nobody does beyond here to the upside for now, which happens when the market gets way outside of its normal range. So if you think you have technical support issues, please contact tech support. Right. Everybody feel comfortable with the fact that our small triggers are still below our synthetic triggers? We're not looking for long trades. What do the small triggers tell us about support? Is it going to break or is it going to hold? All right, so everybody says it should break and turn into resistance. Um, sure thing, MB. At 9:34. Okay. We talked about this one being a long trade. I'm going to go over these simple plan rules again, right? In a trending market, the small triggers maybe get beyond the 8-2 white synthetic triggers as long as they do not get beyond the 12-3 red and green synthetic triggers. You can still do your trend trades. All right, so what we had here was The trend changes to up, breaking above both of these synthetic triggers. And while we violated the 8.2s by a little bit, we still stayed above the 12.3s. You see the difference? Then when we get back to over here, where you were asking why do we not have a long trade, our small triggers violated both the 8.2 and the 12.3 triggers. Let me do this. I'll make it clearer. So once both of our trigger lines got below both of these synthetic triggers, the chances of that market continuing to the upside become less. Do you see that, MB? Okay, so maybe just a little different. And if you took a long trade there, because you said it's a little close right on the edge, you still had to get out after divergence. So it's probably very little money that was in there, very little opportunity. All right, so we've already said the trigger trend was down, right? And we have broken support like we anticipated. So with the small triggers rolled up, what does that mean? Well, we want to see a reversal bar, right? That may not happen. It may break out to the upside again. All right, so we're not going to get a short trade, are we? Well, you guys know what that means, don't you? So we broke out, we pulled back two, and it didn't follow through to the downside. Right, so very simply, small triggers get above everything again, which means what? More potential for long trades, right? It just means we overran the support area by a little bit. Now, very quickly, the small triggers are back above. So the only thing that you can look for is a long trade off of support if we get it. All right, so let me go back and read some comments just to catch up here. Michael, my 2 cents for particular for new traders. You can find a bunch of big moves on any chart that do not correspond to the conservative rules. But overall, probability of this kind of aggressive trades to be winners over long time versus is less than conservative trades. So stick with conservative trade setups. Right? No, that's okay. That's good advice. For those of you guys who are interested, MIG has had software for what, 14 years, 15 years? Keep it conservative. Stay on the right side, correct side of areas, and things will work out for you more often than not. That's really why this lesson today is to keep you visually tuned into the areas and which direction the market should be going. Does everybody recognize and see where the opportunity is? Now, how far it goes, another story, right? So if your entry was pulling back into the area, your stop is very small now. And your stop is now moved up to, potentially break even or better already. So whatever happens next doesn't really matter, does it? If you get divergence, you get out. If it keeps going up, you're still in. Small triggers on the correct side of Fibonacci support. Small triggers still going up. I just turned it off for now. It does come in handy from time to time, but for the super simplicity of what we're doing here, probably not 100% necessary. Right? The end game is to do what, guys? To make a couple $100s a day per contract. That's all you need is a couple $100s a day, right? And then if you want more money, you just trade more contracts. We go back to the beginning of the day. Sorry, I kind of blew my chart out there for a second, so bear with me. Right? That was the first long trade of the day. If your goal is to make a couple $100 a contract, you're done before the day even begins with these simple rules. One chart. Right? Then your first short trade that you had solidified you well over your goal for the day of a couple $100. Then your next long trade with the rules coming together, small triggers above, hopefully really put you at 2 or 3 times minimum your trading objectives by 9:39 in the morning. Siva, you can absolutely do that. You could use a 12 range chart. You could use a 576 tick chart. You could use a 5-minute chart if you wanted to. The beauty of these types of charts is the market price action gets smoothed out, which makes it visually easier for newer traders. All right, so let's go back to where we're at. All right, guys. So you're either still in your trade or you basically have another long trade, right? So if you got out with divergence, your small triggers are still above all of your synthetic triggers. So it's up until further notice. How high is it going to go? I have no idea. Right, and obviously in this type of situation, this is where potentially a larger chart could come in handy as far as target areas. Right, so 46.29 is your Fibonacci target on the big one. So I'll just put a line on here for now. The next version will have fib areas from the larger chart. So there's your Fibonacci area from the larger chart, just kind of superimposed on there. Right, so does everybody understand the simplicity of this thing? Small triggers above, pull back to support, it's going up. Pull back to your mid-band, small triggers above everything. Fib to fib off the 25 buy line, trend trade long. How high will it go? I don't know the answer to the question. You can't make reading the charts any easier. You can't make, understanding where to get in and out any easier, I don't think. If I can, I will do it, I promise. All right, Drew, let me see what you did. You went long earlier and got out. And a long trade here, break even. And then another long trade, and obviously you've got your target way up here for this one. All right, so thanks for sharing your chart, Drew. The nice thing is you can use this thought process on any chart you want. Just a function of practicing, making sure that you are able to read which direction to go correctly. Make sure that you're able to consistently and accurately understand which direction to go and what area to trade from. Once you get that, pretty straightforward. All right, and maybe got stopped out there. If you had it one tick below, you did. If you had it a couple ticks below, you didn't. But you can see we're starting to get a double top with the potential for divergence. Obviously, if we get divergence, that'll really be the end of it for now, and we'll see if it travels a little lower. All right, so we have crude oil news out. Let's see what we end up with. Sometimes it goes really, really, really fast and you can't keep up with it. Hopefully everybody can see that we not only broke above our synthetic triggers, but we also broke above our Fibonacci resistance, meaning that we should go a little bit higher for the moment anyway. Right. Once we get to Fibonacci resistance, we're going to have a breakout either above it to keep going long, or the small triggers are going to have to break out below our synthetic triggers. Right? So we're going to evaluate Fibonacci resistance, right? And the initial read is what? It has the potential to hold because our small triggers are staying below it, right? Now you can see that we have our breakout to the downside of our small triggers, which means what? If we retest the Fibonacci resistance area and fail, we have the ability for counter trend trades. Does everybody see that? Or obviously, if we break through other areas, then we can end up with trend trades if we get back to our fib to fib oscillator. I'm hoping to make the reading of our charts simple for you guys. That's the whole point of this lesson today. To really put together a simple, easy trading plan to be able to recognize when to stop trading in the direction of a trend. All right, so we'll just watch crude for a minute so we don't get any confusion. Can we go long off of this crude support based on where our trigger lines are right now, guys? Okay, everybody says no. Okay, good. Now, it doesn't mean it won't hold, but we're not going long when our small triggers are below everything. It's a recipe for getting run over. So with that, I'm going to take just a 2-minute break. I'll be right back. If you guys have questions or comments, put them in. I'm back. You can see what happened, just going back, obviously, do you want to take a trend trade short, right? Because that's what this was, into your Fibonacci support area. I think we talked a couple times about this concept in the last couple days, right? And that's the reason why we use that fib to fib. Can you take a short trade there into a fib and then manage that trade tightly? You can. If you're waiting for a full breakout of both, that's okay too. There is no right or wrong way. Right? There's some traders that are a little more aggressive than others, and they say, hey, I'll trade into a fib area, but I'll manage that trade tightly. All right, so Jim, yeah, outer bands and one-to-ones always good. All right, so we have basically a line in the sand, right? We can't really get much past our mid-band, or we're going to have the small triggers break back above our synthetic triggers. Right? So I think very clearly the trend was down, and it hasn't changed. Right? This is why I added that portion into these rules that I gave you guys this morning. In a trending market, small triggers may get beyond the 8-2 white triggers to get to the area. As long as they don't get beyond the 12-3 red and green synthetic triggers. Right? So you can see we had that where it overran the white ones, but just got to the red ones. Just using colors. Some people will take it into a fib and manage it and hold on until we lose momentum down here. All right, so here's where we're at currently. I think everybody can agree that the trend is down. Right? As long as our small triggers don't get above, right, price-wise, this area right here, top of our synthetic triggers. Right? That's the line in the sand for the bottom of the trigger line. So conceivably, we can go up a little bit higher, right, and not have those triggers break through all of our synthetic triggers. which means that this is probably the last potential short trade until we get a deeper retracement, if we get a short trade. George, have you been here all morning? Out of curiosity. I mean, I don't track who's in and who's out. All right. Well, that's what we've done all morning is overlay these rules on top of the market. I did record this session so you can go back and watch the last hour and a half worth of all that work later, whenever you get some free time in the afternoon. So do you have a copy of those rules? I'm going to give them to you. This is nothing different than what we do every day, guys. So there's a link to it again. Right, but the rules are very simple. The small triggers, right, are the focus. And we use the small triggers to tell us whether an area, the mid bands, or fibs are going to hold or break. Right? If the small triggers get much beyond a mid band or a fib, we don't use that trade anymore, area anymore. And we also use the small trigger lines to define a trend change. Right? So you can see our small triggers broke below all of our synthetic triggers over here, which changed the trend to down. We bounced off a support, but all we were doing is testing the upper end of the downtrend from our midband. And the trend remains down until further notice. Hey, George, it's very simple. If the small triggers are below the synthetic triggers, we're going to be looking for shorts, right? I don't know why I have to write that on the chart. I'll write it on for you if you want. But what's the difference? I don't understand how it's going to change. Look, here's what we wrote earlier. Small triggers break below. We're going short. Here's what we wrote before. Small triggers break above our synthetic triggers. We're going to have a long trade off of support. Small triggers break below our synthetic triggers. We're going to do a short trade from resistance. All right. Going back to our NASDAQ chart for the day, since you were not in and kind of missed it. Small triggers got above our synthetic triggers, right? See that? We pulled back to support for a long trade. You see the pattern? Small triggers get above your synthetic triggers. Long trade off of support. All right, so we break above resistance. We have a trend change down. Small triggers below our synthetic triggers. And we have a short trend trade, right? Pull back to our mid band of resistance. Pull back to our fib to fib oscillator at 75, and the market goes down. Then the market changes trend back up to the upside. Small triggers get above our synthetic triggers. We pull back to support and we get a long trade. See that? So I'm just kind of reviewing. So all we're doing is looking for the trend to change up, pull back to support or resistance, and then be able to take trades. The trend changes back to up. Don't really pull back to any supports for long trades. Then we had news out at 10 o'clock, so it kind of bounced around a little bit. And eventually we had trend changes to up with the small triggers above, and we have a long trade. Then we have no more long trades for a minute. And then we have small triggers breaking back up to the upside. Breaking up, see? Then we have pull back to support for long trades. The market goes up. The small triggers are still above all of our synthetic triggers. We use our fib to fib oscillator off of the 25 buy line for more long trades to the upside. Now, live, our small triggers are going down below our synthetic triggers. Right? You see that? Which means what? We're going to be looking for short trades from resistance. So, going back and adding up all those trades puts you probably $500 per contract profit. All right, George, did you study that video that I sent to you yesterday too? Just want to make sure. So there's two areas that you can buy or sell, right? Our mid bands or Fibonacci support or resistance, right? Do you remember that lesson from yesterday? Which means what? You need to, the resistance is your mid band area. So somewhere around there, give or take, we're looking for shorts. All right, and then you also remember that for our trend trade short rules, we need to have our fib to fib oscillator get up to this top white dotted line, which is our 75 sell line. So if we get the market to retrace and we get our fib to fib oscillator to come back up, we're going to be looking for short trades. Rodney H., you also got short, took some along the way and out towards support. So nice job, Rodney. And Jerry, let me see what you did. You went short off of that first short that we talked about from the mid band. And you took approximately, 50 ticks on that short trade? So $500 a contract on that whole move. Nice job. 63 ticks. Okay, I stand corrected. So Drew, you also went short and you took $200 on the first one and $350 on the second contract. So $550 for one move. Nice job. And then Howard G, you also went short, 09 down to 80, so you took 29 ticks on that. Nice job. And Bugsy, let me see what you did. You had a little short in there on your larger chart, and you were able to capture, looks like 8 ticks of that. All right. All right, so you can see what's happened here on our NASDAQ, right? We didn't get any short trades from resistance, which is fine. Right now our small triggers are starting to go above our synthetic triggers here, which means as long as they remain above both, we're going to be looking for long trades now. Right now, when we look at crude oil, you notice that our small triggers are now above all of our synthetic triggers. And they're also starting to break above fib resistance in the midband here, which means what? No more shorts for us. Right? We want our small triggers and price to be on the correct side of all of our areas in our synthetic triggers. So the small triggers are going up, but the areas stay down, which means we do a whole bunch of nothing for now. I think you guys are starting to get the idea behind this, right? All right, Bugsy, your last trade was short 23 down to 86. Nice job there. JS, have you posted any trades? I'm trying to remember where your trades were. Going back through the day, you had posted a chart, but no trades on it. Just going back to the beginning of the day. All right, guys. So here's where we sit on the NASDAQ, looking for potential long trades. I kind of missed this on crude. All right. If I missed a chart, Richard, sorry. I'll go back and look at it, though, if you need me to go back and look at it. Almost everybody had the same trade, so if you have a chart you want me to look at, repost it because there's too much going on in there, so I might have missed it. All right, so when are we going to say no more long trades? And you guys can see on crude oil, small triggers got back down below, and the market's still going down, which is not surprising, which means what? We're going to support. So crude Small triggers on the wrong side, small triggers on the correct side, and easier to the downside. Now we've got our eyes on the small triggers on our NASDAQ market, right? If our small triggers get below all the synthetic triggers in our mid band here, we're not going to take any more long trades, right? All right, Scott, you did get short on crude, and I guess you remain short. Drew, let me see what you did. Um, all right, so trend trade short. I think we looked at that one, and then all right, so trend trade short into support anyway. All right, Drew. So we saw yours, and JS, you were in a short trade and you jumped out. So you took that short here, but decided to get out of it. Right, okay, Drew. Pretty much everybody's got the same trades. So Jim B short from the mid band and tightly managing that one and getting back in again and taking some money. Clarence, so you were short. How bad is it not to wait for the fib to fib to get there? You know, sometimes the fib to fib doesn't get there. Right? So it's, Clarence, a matter of what your trigger lines are doing. Do your trigger lines say it's okay to not wait for the fib to get there? Right? Are the trigger lines so favorable that you don't need the fib to fib? That's what we're talking about. All right, guys. So I'm going to take a 1 minute break. I'll be right back. We'll let you guys watch charts here in the meantime. So I'll be right back, and then we'll get back after it again. All right. MB, let me see what you got here. Short from resistance, plus 12, plus 4. Short from the midband. Thought your rules were broken, so you exited positive. Short again and again. So you lost 9 ticks on that trade, but short, plus 12 again. All right, so if we add it up, plus 12, plus 4, plus 12, plus 12, net positive. And again, the only reason you took that loser and you even put it on there, bad stop placement. Okay? So that trade you should have still been in and still got your 12-12. So technically you should have had 40 ticks on those trades. That's all right though. Good recognition. And MB, you went long after the reversal bar. And you did not manage it off of the 8-2 small triggers. Again, remember we talked about this morning. If the small triggers are on the wrong side of the 8-2, then you have to manage out tightly. All right, so I know you've got your own rules, but you can see the concept, right? Small triggers below the 8-2s. Is there really a reason to take the whole loss on that thing? Probably not. All right, so when we look at the NASDAQ, basically one trade. Long trade, totally fine with it, absolutely nothing wrong with it, right? Trend trade, long. Recognizing we're on the wrong side of the 8-2 small triggers, which means you have to manage the trade. Now everything's back up again. Now this line at 629, remember, was our fib on our larger chart, which I don't have superimposed on the smaller chart. So 29, 40, or 30, something like that. David, let me see what you did here. Went long on a breakout and right. So you recognize, obviously, getting in on the breakout, you had to have a huge stop, but you did. And obviously this would have been an easier spot to get in and took some money. Then this one tried to go long, it looks like. Or no, you went short here. Okay, so everything rolling over and breaking down, you went short and then got out. And then you went short off of your mid band and got out at support. So 100% winners. Maybe not quite the best execution you've ever put out there, but you still won. All right, Andre, you also tried a trend trade long, but you managed it well coming off of those 8-2 triggers. So good job of that. Clearance, crude oil short off of the mid band, which I can get on board with every time. I know it's a little outside of the basic stuff of what we were talking about today, but I can still get on board with it. Nice management on that one. Not a home run, but you got 5 ticks out of it. And then David, I saw yours. Don O. First trade of the day. Plus 10 ticks. So, nice job there. Taking that winning percentage up. MB. So you did the earlier long trade, obviously, but you took a second chance opportunity as the small triggers got back above the mid band and took 12 and 12. All right. So if we could have just cut your loser in half, then you'd be net positive on all that. All right, guys, so let's take a peek at our crude oil. And you can see that, right, we're not doing any more short trades because our small triggers are above our synthetic triggers. Typically, when you get the small triggers to break out of your mid band and your synthetic triggers, usually you're going to see the market go from, a pullback into your 8.2s up to this area. Again, this is not necessarily the least aggressive trading that you can do, but that's usually what happens. Right, so you just have to recognize at this point to some higher levels. Right? Small triggers breaking above your mid band means your mid band's not going to hold anymore, which means you're probably going to get up to some higher levels before you make any more decisions. Right, so what we want it to do is to come back up, make a nice deep retracement, and then one of two things: either break through resistance where we keep going, take some long trades, or get our small triggers to say it's okay to start selling the resistance area. Does that make sense? All right, Bugsy, let me take a look at your last trades. Entry area, a little more aggressive on the entry, and then a reversal bar entry. And you just decided to get out a little quicker. So 16 ticks on the first one and 2 ticks on the second one. All right, so net up 18 ticks on that little run through. Good deal. All right, Ed, let me take a look at what you did. It's not coming up for some reason. All right, so we've got some work to do for crude oil to get back up to this area. And you guys see what I'm talking about with the small triggers breaking up above our mid band, turning it from magenta to green, and our synthetic triggers crossing up. So not necessarily a trade setup to the long side, but just recognizing that the market usually with this look will have a tendency to push up higher. And still uptrend on our smaller NASDAQ chart for now too.